All right, we're going to work. It is number 7 on chapter 9. It's the TIF 9-4. Okay, I know where I copied and pasted it over right here is kind of hard to read. But this is one of those, you may remember when I was doing the lecture, I came up here and I put the accounts receivable and the allowance for bad debt, and I kind of showed you how all the moving parts go together here. So this is a really good example of putting those numbers where they are supposed to go. Okay, so I did just that. I'm going to erase my numbers just so we can read through it. The first thing it says at January 1st, Fall River Company had accounts receivable of 28,000. That's the beginning balance. Okay, that's the beginning balance. They're telling us what it was at January 1st. Okay. Then they said during the year, Fall River earned sales revenue of 164,000 on account, okay? On account. So that is the credit sales right there. Okay? I'll mark that because we need that. Okay? That's our credit sales. Let me make that see a little better. That's kind of bugging me. There we go. All right. Then the next thing after that, it said, and it collected 135,000 on account. So that is right here in accounts receivable. If we come back up here, customer payment, that's what we collected, credit sales. That's where the 135,000 goes. Then it says Fall River Company wrote off $2,300 in receivables as uncollectible during 2025. So that 2,300 would go here and 2,300 would go there. Okay. It does tell us they use an allowance method, so we know that we're going to have that allowance for bad debt. Okay. So I think the first one probably was, you could overthink this one. Okay. Because the first one is just using bad debt expense based on credit sales. This one's super easy because all we're going to do is take that credit sales of 164,000. Let me find my calculator so you can see me put it in the calculator. I know you can put it in the calculator, but sometimes it helps to see somebody else doing it. Do something with it. 164,000, and we're going to multiply that times 0.03, and that gives us 4920. Okay, so that first one, I don't know why they called it number 12, but that first one was 3% of credit sales. We will debit bad debt expense and credit the allowance for bad debt. Okay. So that was 4920. And I did check that. That is the correct answer for that one. Okay. All right. So the next thing we're going to do, the next one is the hardest one. Okay. This is the one that I told you I graduated up, and this was the absolute hardest one. So if you didn't get it, don't feel that bad about it. Okay. Because it is the hardest one when it comes to bad debts. Okay. They gave us all of this information. The only problem I had when I was calculating this, because I put that 2,300 there, thinking that was going to be part of the calculation, but it is apparently not based on the answer. Okay. So the next one said, assume Fall River Company had an unadjusted $1,200 balance in the allowance for bad debt at December 31, 2025. That makes sense. So this 2,300 came, and then so let's say 12/31, they had a balance of 1,200. Okay. They want us to journalize the entry for bad debts based on 10% of the accounts receivable. Okay. So we got to come over here. We need all of this information right here. I worked it a while ago, but I took the total out. So we're going to take the beginning balance, add the credit sales, subtract the cash payments, and subtract the write-off. Okay, so I'm going to start 28,000. I did not do that right. And then I'm going to add 164,000. Then we will subtract 135,000 and subtract the 2,300. Okay, so that gives us a balance of 54,700. Okay, they're telling us that they're estimating bad debts to be 10% of the accounts receivable. So I still have that 54,700 in my calculator. So I'm just going to multiply that times 10%. That number, 5470, is not my bad debt expense. It is my ending balance in the allowance for doubtful accounts. And I put too many zeros in there. Okay. So 5470. That's what our ending balance should be. All right. So now we have to back into what is our bad debt expense. Well, we already have 1,200 in there. So we're going to subtract the 1,200 and we will get bad debt expense for this period of 4270. Okay. The journal entry, the debits and the credit is the exact same account. It's just a different amount. Okay. This is what's very confusing about this. When you do any kind of aging balance sheet method, you're calculating that ending balance. You're not calculating the bad debt expense. You have to come back and back into that bad debt expense right there. Okay, so I know this is a hard one, so don't beat yourself up too much. It takes a lot to get both of those correct. Before I end the video, I'm going to jump over here and you can see the answers for those. All right, I will see y'all in the next video.